Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 22nd of April. Let's dive into the week's stock market news. European markets gain as ECB signals further cuts and UK inflation moderates. European stock markets experienced a positive trend in the last week concluding April 17th, with the Pan-European Stocks Europe 600 index climbing 3.93% and recovering some ground lost earlier in the month. Investor confidence was bolstered by indications of potential further interest rate cuts from the European Central Bank ECB and a reported decision by US President Trump to postpone the implementation of higher tariffs. This upward momentum was reflected in major national indexes as well. Italy's FTSE MIB increased by 4.97%, Germany's DAX advanced 3.13%, France's CAC 40 added 2.24%, and the UK's FTSE 100 saw a gain of 4.58%. Aligning with market expectations, the European Central Bank reduced its key deposit rate by 0.25 percentage point to 2.25%. Significantly, the ECB removed previous language suggesting policy was becoming meaningfully less restrictive from its statement, and reiterated its commitment to a data-dependent, meeting-by-meeting decision process, avoiding pre-commitment to a specific rate trajectory. While acknowledging progress in the disinflation process, the central bank expressed concerns about a deteriorating growth outlook linked to trade policy uncertainty. We interpreted the ECB's communication as a strong signal of intent to lower borrowing costs substantially below the neutral rate, potentially reaching 1.5% or lower, exceeding current market expectations. Meanwhile, economic data from the United Kingdom revealed a slowdown in inflation for March. The headline inflation rate decreased to 2.6% from 2.8% in February, attributed to lower prices for items such as gasoline, games, toys, and hobbies. This figure came in below economists' consensus forecast of 2.7%. Furthermore, services inflation, a key metric for policymakers, also decelerated more rapidly than anticipated, falling to 4.7% from 5%. In the labor market, official figures indicated some weakening, although wage growth persisted, while the official unemployment rate remained steady at 4.4%. Data derived from tax authorities showed a decrease of 78,000 employees in March, the most significant drop since 2020. Despite this, average weekly earnings excluding bonuses grew by 5.9% in the 3 months leading up to February compared to the previous year, slightly up from the 5.8% recorded in the prior 3-month period. Now our insight into alternative markets, public to private transactions. A strategic move linked to takeover threats and governance. In the dynamic landscape of corporate finance, the transition of a company from public ownership to private hands, known as a public to private PTP transaction, is a significant event. While often driven by financial motives, such as perceived undervaluation or the desire for strategic flexibility away from quarterly market pressures, PTP buyouts carry deeper implications, particularly concerning corporate control and governance. Indeed, initiating or undergoing a PTP deal can sometimes serve as a strategic, even defensive, maneuver, especially in the face of potential hostile takeovers, and may reflect underlying issues with a company's existing governance structure. A PTP transaction fundamentally alters a company's ownership and operating environment. When a private entity, frequently a private equity firm or sometimes the company's own management team in a management buyout or MBO, acquires all outstanding public shares, the company is delisted from public stock exchanges. This shift removes the firm from the direct scrutiny of the public market and associated regulatory requirements, allowing for potentially longer-term strategic planning without the pressure of meeting short-term earnings expectations. One intriguing facet of PTP deals is their potential role as a defense mechanism against hostile takeover bids. A hostile takeover occurs when an acquiring entity attempts to buy a company against the wishes of its management or board. One, by taking the company private, the existing leadership or a friendly private buyer effectively removes the company's shares from the open market, making it impossible for a hostile bidder to acquire control through public share purchases. 2. The PTP becomes a definitive barrier to such advances. Furthermore, the mere threat of a takeover can itself be a catalyst influencing corporate behavior, potentially leading towards a PTP transaction. The provided subject suggests that this threat can act as a substitute for an ineffective board of directors. If a company's board is perceived as underperforming, perhaps failing to maximize shareholder value, leading to a depressed stock price, the company becomes vulnerable. It presents an attractive target for activists or hostile bidders who believe they can unlock greater value. In such scenarios, the board and management, facing the possibility of being ousted in a hostile takeover, might proactively seek a PTP deal with a preferred partner as a way to retain some control or secure better terms than might be offered in a hostile bid. This links directly to the profound impact PTPs have on corporate governance. Moving from a public structure with dispersed shareholders and stringent regulatory oversight to a private one with concentrated ownership, often by financially sophisticated private equity owners, fundamentally changes accountability and incentives. Private owners typically take a more hands-on approach, often installing new management or working closely with the existing team, focusing intensely on operational improvements and value creation, albeit without public disclosure obligations. In this sense, if a PTP arises from a situation where the public board was deemed ineffective, the transaction itself forces a governance overhaul, replacing the old structure with one characterized by closer monitoring and different strategic objectives. Therefore, public-to-private transactions are more complex than simple changes in ownership. They exist at the intersection of finance, strategy, and corporate governance. They can serve as a powerful tool to shield companies from unwanted suitors, and the circumstances leading to them, particularly the threat of a takeover, can highlight and ultimately address perceived weaknesses in the governance structures of publicly listed firms. The possibility of such transactions thus forms part of the broader market ecosystem that influences board behavior and corporate decision-making.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T Hub Capital team.